Well, welcome. Happy New Year. We hope everyone had a healthy and happy holiday season. This is the first of the monthly webinars from Principal Wealth for 2025. This one is titled The Balancing Act, which we will talk about in a moment. I am Julina Ogilvie. I'm partner and wealth advisor here at Principal Wealth. I am joined by Bob Paolucci, our founder and CEO. Bob, Happy New Year.
Happy New Year. Good morning. We have a thorough presentation for everyone this morning.
I mean, man, do we. We weren't even days into this year, probably even starting last year, that we were putting together our thesis for this upcoming year. And one of the things I think we pride ourselves on in being an independent firm is not only our independent investments and financial planning, but our research. And I have to emphasize going into this that this is not a boilerplate view from a corporate firm that we are turning around and sharing with you. This is not Wall Street's view that we are turning around and sharing with you. We have to thank Kyle and our team because when we met originally to talk about this, we started with over 120 slides as to what we might be able to share with everyone. We're certainly not going to share all of them, but we do want to try and tee up the year and give you some ideas in today's webinar about what to think about going forward, if that's fair to say.
Yeah, there's a lot to talk about. There's a lot going on. There are probably more pieces, more items that can influence outcomes this year. Expect a lot of change and expect a little bit more volatility than we've had over the past couple of years, because generally speaking, we haven't had as much as we should have. So we think more volatility and lots to talk about this year.
Yeah. And we're going to talk about this as well. More volatility isn't necessarily bad.
Right.
And what we want to do is let me quickly share our agenda with you. There's going to be three components of the presentation. We're going to first review 2024, what we think worked, and we're going to start with our forecast for that year. We're going to talk about 2025 and what we think matters most in this year ahead. We're going to focus on long-term interest rates, the policy trifecta, regulation, employment, and earnings and buyback. The bulk of our view for this year is going to be upfront. And then if you really want to dive into our thesis around this, we are going to talk about the stock market, the bond market, economy, and policy as well. And then if you can wait with us till the end, we have this section called Everything Else, where a lot of what you don't hear from in mainstream media, we're going to focus on real estate, China, cryptocurrency, AI, GLP-1, and the baby boomer buffer, all in today's presentation.
There's something for everyone, Julina.
There is something for everyone.
Look,
Absolutely.
and ultimately, if you really want to understand how we come up with our ideas and our views, we look at everything and we condense it down and we find the connective tissue. We identify what's possible, filter it down to what is likely and logical, and that usually is the right thing to do. It's worked out very well for us over a very long period of time. So this is giving you maybe a little bit more color behind some of the calls that we're making, our opinion, our positioning, and why. We believe it's better than just listening to someone's, mindless 30-second view of the world for the next 5 years. It's void of detail. It doesn't really give you much. We like to give you a little bit extra and some context, and hopefully that helps educate you. Hopefully, you're certainly getting some nuggets out of these presentations. You're learning because that is our goal. The other goal is to make sure you understand we're doing everything all the time that we can to put you in the best financial position that we possibly can. When it comes to this stuff, it is really through the lens of really portfolio management, and we're giving you some insight as to how we make decisions and things that we look at. So hope you
Absolutely.
enjoy.
All right, so let's kick this off by taking a review of 2024. And to do that, we started looking at the January webinar of 2024 and looking at our thesis back then. And if you remember this presentation last year, we actually deviated from Main Street media in a lot of what our thinking was for the upcoming year. And so, Bob, if you want to review some of those talking points and how successful we might have been.
Yeah, so ultimately, looking back, the key drivers last year ended up being the key drivers through our lens. The direction of earnings, our expectation was, look, we're still in recovery mode. We were entering the second year of a bull market last year. Earnings growth is usually better than everyone expects. Somehow expectations don't change. We have data and history to look back at. It doesn't happen. So we were relying heavily on the historical trend of a second year of a bull market. Earnings were very likely to come in much stronger, and boy, oh boy, did they. That certainly helped propel the market higher. The direction of interest rates. So, if you remember last year, the Fed was confused, and so was Wall Street. There were expectations for three cuts, no cuts, one cut. Some were saying five cuts. We were on the more aggressive side. We thought, look, as the Fed kept talking about tying themselves to inflation, tying themselves to the data, we said, well, that's easy because the data is going to allow them to bring rates down. We were taking the over. The market mostly throughout the year was expecting two cuts. It got four. The Fed woke up right around summertime when inflation, really started to plummet down, and they delivered four cuts. Again, that is what we expected. That happened. The direction of inflation, again, tied to interest rates, tied to the move in interest rates, but inflation was going to be much lower than the Fed's forecast and the market's forecast, and that was absolutely right. Cash levels, we thought were going to be very supportive of capital markets and consumption and expansion and good feelings, and they still are. And then we also said, if we end up going into a recession, it'll be the best one we've ever had, meaning highly unlikely that we were going to enter a recession. So we said no, and we were right. So those were the big drivers we thought from last year, and I think it looks like we got it right.
Yeah, absolutely. Let's first address in last year where the S&P ended relative to Wall Street's expectations.
Yeah, so we have a lot of fun with this internally, and I think many of you have seen the Wall Street expectations versus Wall Street results. We're going to show it to you again. So last year, here are all the big firms, the big Wall Street firms, and their expectation for the S&P 500 at the end of last year ranged from 4,200 J.P. Morgan. That's where they thought the S&P was going to end the year, 12/31 of 24, all the way up to Yardini, Ed Yardini at Yardini Research, one of the more accurate forecasters out there. He was closest of these big Wall Street firms at 5,400. However, everyone was wrong. The S&P 500 ended the year just above 5,900. So that is one of the widest spreads between actual results and expectations. It just goes to show you a lot of these forecasts are taking earnings times a multiple and putting a number out there, not really understanding what else can go into it during the year. No one wants to be really wrong, so they usually give this 7 to 11% forecast, and they stick to it. Those that are willing to put themselves out there will give a forecast if they really truly are bearish, that's way below. And if they really truly are bullish, way above. It doesn't look like we had any of that on the bullish side last year.
Yeah, I remember having this exact conversation last year in that the forecast from Wall Street was almost is almost as extreme as what we're seeing today.
It was close.
Yeah. And the other thing I think that's important as we talk about the markets last year is the media is laser focused on the S&P. Another, 2 years in a row, north of 20%. And everyone's looking at that number. But if you're a traditional investor and you're diversified, I think you need to be aware of what a diversified portfolio may look like.
Yeah, the vast money, investor money invested in this country is through some type of portfolio diversification. If you're at Vanguard, if you're at Morgan Stanley, you're at Schwab, Fidelity, wherever you are, generally speaking, you're going to have a diversified portfolio, as you should, which means you're going to have exposure to the S&P, you're going to have exposure to small caps, to bonds, to some cash, maybe some municipal bonds, maybe some foreign stocks, maybe some other stuff, right? So the vast majority of investor money, let's just say almost all of it, is invested in some combination, some ratio of stocks to bonds, and the stocks are diversified. It's not just the S&P, it's a lot of other stuff. And the bonds are diversified. It's not just treasury bonds, it's corporate bonds and some other stuff. So, the big proxy that we will use, and, the entire world really uses, is the total world market index. In essence, it's the S&P and most of the big companies from the rest of the world, sorted by market cap or weighted by market cap, and then the Vanguard Total Bond Market Index or the Aggregate Bond Market Index, right? Use these two and weigh them based on your risk tolerance, 50-50, 60-40, 70-30, or any combination you want. And it's very easy to do the math. You take the return of, let's, in this case, call it the Total World Market Index by Vanguard. Symbol is VT. You can invest in it. It returned 16.48%. That is the world stock market return. Let's say you have a 50-50 portfolio, so you take half of that return. Then you take the other half of your return times the bond market return, and that gives you, if you had a 50-50 portfolio, about an 8.91% return, right? A 60-40, somewhere around between 10 and 11, depending on the index you use. 70-30 would have given you just about 12. Most investors, how did they do in this world? Very specifically this country. This is how they did. Outside of this country, if they were very heavy ex-US investments, they did not do nearly as good as this.
Absolutely. And I think to help investors understand maybe not only the markets last year in different asset classes, but over time, this is one of my favorite slides. I think, we like to call it the jelly bean chart, where it kind of looks back well over a decade, 15 years, on what the best asset classes were year by year on the top, and then looking at the worst asset classes all the way at the bottom. And not surprising, the worst asset class almost every year and out is cash, which makes sense, which is the purple. But I will point out that commodities also tend to lie at the bottom of this slide as well. And every time they do well over a short period of time, everyone gets excited and they want to ask about commodities. But I just thought I would point that out.
Yeah, so this chart is mostly random. There are small bits of consistency. You can see this chart illustrates an asset allocation square, which is a little bit of all of these asset classes, and it hovers somewhere around the middle, on average, slightly above the middle, and it just gives you a good return with exposure to all of these while minimizing the risk of a singular risk style or sector or asset class, right? So that
Yes.
is how investors invest and how they should invest. Imagine being a commodity investor. If you look at the bottom from left to right, you would have no return. You might owe some people some money because commodities tend to be the worst asset class to invest in and one of the most volatile assets to invest in. So you can see little bits of consistency. Somewhere in the middle, you have the asset allocation, white boxes. Down the bottom, you have cash and commodities. They tend to be the worst asset classes always over time. That was almost the case last year. Certainly was the case the year prior, and will very likely be the case in years ahead. Again, look, if you ever see commodities have a very good year, run for the hills because it's very unlikely to happen again, right? You
Yeah.
typically.
And I think this is also, if you look at the top over the last 2 years, just another confirmation that large caps were the darlings for 2023 and 2024, north of 20%. And then the last thing I would say is I heard this from someone years ago. I want to say he was a member of the Yale Endowment, but looking at that white chart, which is the asset allocation return of all of these boxes, he said diversification never works at a point in time. It is never the winner of the year. However, it works over time. It is the most successful way to get to that endpoint. And so I think that this is hopefully a good visual of that.
Absolutely.
So taking it one step further to look at the S&P again, kind of talking about that return that we saw last year, an incredible year at 23.3%. I think it's also important to look under the hood. The average performance of the constituents of the S&P 500, the average was 13.45%. And then the median, which is just taking the middle of the pack, was just shy of 10.
Yeah, so I don't think a lot of people understand that there were 168 stocks that were down last year, and a good number of them were down greater than 20% of the ones that were down. At the same time, we had 59 all-time highs last year. So, I think everyone has heard enough of the Magnificent Seven, NVIDIA and Apple and Microsoft and Google and Amazon, so on and so forth. Yes, they propelled the market higher. They are the big companies, the big grown-ups that have a lot of earnings growth, a lot of cash. They did well in 2023. They did horrendous in 2022, but
Yeah.
again, they have a lot of slack. So what we did see, and we'll get into this more, is during the year, we thought this year specifically that we would start to see the rest of the market start to catch up and participate a little bit more. And it did, and we'll get into that. We're talking about small and mid caps. But this is sort of the under the hood of the S&P 500. It wasn't all roses.
I think just another few points that I think are important to remember about last year. One of them is we addressed earlier is about the Fed, and how and their cut path last year, along with the economic growth with GDP.
Yeah, again, more review slides. We'll get through this quickly, but the Fed cut four times. There it was. There were three actual um, meetings where they cut, but again, the September meeting was a double, so it was 50 basis points, 25, so 50 in September, 25 in October. No meeting in November. Actually, a meeting in November, and then one in December to end the year. So GDP, it's just an interesting chart that just shows 1 year growth of GDP, which came in just shy of 3%. So that's above trend economic growth. I know it doesn't sound like much, but the big cruise ship that is the United States economy, if it moves by 2 to 3%, that's a lot. We think that will continue this year and potentially for a couple of years. We'll get into that more. But here's how it looked last year. Also reinforces the inflation and unemployment theme. So
Yeah.
inflation came down quite a bit, both at the core and the headline level. On the right side, unemployment rose. Again, the Fed's dual mandate. They have two things that they are supposed to control and two real things that they should pay attention to. So one would say the two big data points are price stability, which is inflation, and full employment. And you can see that through labor participation, the unemployment level, so on and so forth. The Fed is starting to get a little worried about employment. It's Friday morning. We just had a jobs report that came out. I can't read into the monthly jobs reports, but the job report came out saying, "Hey, we uh, in this country we hired more people than expected, and then the market's reacting to it, and the bond market is reacting to it. Uh, we don't really react to it because we know in 6 months there's going to be a revision looking."
Yeah.
Back 6 months, just like they did in the summer of last year, you had all of these reports, the monthly reports that said we grew jobs by, whatever we grew them by. And then late summer, the data point was, oh, we revised down jobs looking backwards by about 1 million. I mean, so
Dramatic.
it just makes you wonder, how are they counting?
Yeah.
Uh, right? I mean, you can't mess it up if you're using a calculator or a spreadsheet or even an abacus. And generally speaking, these are estimates, right? So don't read into it too much. The market does,
Yeah.
and it moves based on some of these data points. But we think the trend for unemployment level will be higher, not by a lot, but by enough for the
Mhm.
Fed to pay attention.
Yeah. Lots of short-term emotion, which kind of leads us into the next slide, which addresses a little bit of the limited volatility that we had last year, which is funny because we did end the year with some and people started to get anxious.
Yeah, so correction free for 2024, the twin of 2023. So it's cute. If you look on the far right-hand side, you'll see that the S&P 500 had back-to-back 20% returns, which I believe has happened only four times in history. Just a little teaser when that has happened. The other times that has happened in history, the following year had a return of greater than 20%. We're not
Yeah.
making any promises, but the four times that it has happened, the outcome was another year of 20% or greater returns. But what I look at on the far right hand side is we didn't have a correction,
Right.
right? And a correction is a pullback of 10% or more through our lens on a closing basis. And there are these trend lines, and these levels, key levels, where investors step in just before 10%, then they move the market higher, then they change the pattern of the market, and that's why it never really gets to a certain level. We think, because history tells us to expect a 10% correction, roughly every year. We think we're due for one. We think we might actually be in one right now. We're halfway there. The market's down about 5% from its high. You may not know that because how it happened and when it happened. It started in December. We were having an okay December. We had a little pop, we had a top, and then a little pullback, which
Mhm.
has now bled into January. So we fully expect a 10% correction. And we fully expect to take advantage of it, and we are looking forward to it because it gives the market a little breather. We've
Yes,
always said it's like running a marathon. You have to run a slow lap so you can finish that marathon. If
right.
you run hard, and you're just an average person, you may not finish the marathon. So we're looking for a little bit of a breather from the S&P 500 this year.
Yeah.
We think we're going to get it. So
And maybe this is very similar to the trend of a lot of Americans that choose to not drink alcohol in January. This is a
right,
cleansing effect.
right.
And last point of last year, we talked, one of our themes was this abundance of cash and what it can do to propel the markets. We were joking last year as to the elevated level of cash that we hadn't seen in the pandemic or the financial crisis. And yet, looking at this slide, that has continued to go upward.
It's amazing. Look, there is something else that is pushing this. Typically, when you see an abundance of cash, it's not chasing yield. It is chasing safety.
Hmm.
That makes sense?
Yeah.
So in prior peaks of cash, it was really running for the hills, and it didn't mind that the hills didn't have any yield, right?
Yes.
What happened was the initial boost of cash this go round was through the government providing fiscal stimulus to people, to businesses, multiple times over, multiple rounds, way too much, which created a cushion and ended up being a scenario where all of that stimulus wasn't needed, but there was no way for them to get it back.
Yeah.
So it just stays in the economy, stays in the markets, stays in money markets. And it happened at a time where very briefly during the pandemic, rates went to zero. Um, but you know, don't hold your breath. Rates quickly in 2022 went from zero to way too high,
Hmm.
over 5%. So what do you know? All this cash, which typically when levels reach this level, usually have no yield, it's getting yield.
Right.
So in this case, you're looking at a chart that shows cash in 2022 and in some of 2023 being a decent investment
Yeah.
with a well above average yield, and you're seeing some compounding. And look, money will go to where it's treated best. And for a short period of time, it was treated best in cash.
Hmm.
Now, for the past, let's call it 20 months, it hasn't been the best place to be, but it is still, and you know, could still be somewhat attractive.
Yeah.
Um, as the Fed cuts rates, short-term interest rates come down, cash yields, bond yields on the short end come down with it.
Yes.
So it's looking less and less and less appealing. But investors don't care. Cash investors don't care. They will be the last to remove themselves from that asset class. And usually that is years from now, near the peak of a bull market, which we think is quite far away. But what you see right now is you have this mountain of cash, which you have to understand acts as a cushion
Hmm.
to bad times. So we have this enormous foundation, this big backbone, this stable backbone in our economy and in our markets to rely on. I say that because whenever we've had cash levels that are high, that's what
Yeah.
it does. It provides.
Absolutely. And
Yeah.
thank you for going through that. And I think that this is, the outlook of 2024 is important because some of these themes are going to flow into this year, and some of them may not. But hopefully that sets the stage for our view for this year. And as we kicked off this presentation, we talked about the title. It was the Balancing Act. And you have here a visual of what's called the flying Wallendas, which are a circus act. They're a group of daredevils back in the 40s that performed these high wire acts. But our goal with this is to share with you that this year is going to be a balancing act of policy, economy, if you want to kind of walk through that.
Yeah, it's, I think for many, many are struggling with, wow, there's a lot going on. The Fed may or may not do something. We've had two very good years in the stock market. Can it last? Is this the top? What about the fiscal side of things? Are we going to be spending any money? Are we going to be spending too much money? What about trade? What about politics? What about this? What about AI? What about China? So on and so forth. And there's a lot that is riding on this tight wire.
Yeah.
Um, and ultimately, if it gets out of balance or the decisions get out of balance, there's risk, right?
Yes.
And in the case of the flying will end, there's a lot of risk because there's no safety net. In the case of the capital markets, there is a safety net. There are other asset classes that can take away most of that risk and actually provide yield or return, so on and so forth. So flying will end us.
The
It's the new
flying
term.
Melendez. And so,
Flying will
and I
end.
think to kind of kick off our view for this year, as I mentioned earlier, what matters most to us, we address in five key areas.
Yeah, so the boss. There is something that owns the stock market right now, and it doesn't act up all the time, but when it does, the stock market pays attention. It is like the drill sergeant. We'll call it the boss. That is the 10-year Treasury yield, and the 10-year Treasury yield is often referred to as the risk-free rate or the benchmark interest rate of the world. Why? Well, because it is, and it's very important. It has an impact on lending, therefore borrowing. It has an impact on valuations, what a business is worth. Another impact is if that yield is very high, right? It
Mhm.
attracts capital away from other areas of the capital markets, right? Again, the whole theme of money will go to or gravitate to where it is treated best.
Yeah.
And hey, at a 5% yield, the 10-year Treasury, or just about there, looks attractive again. Another important topic that we think is going to show up in many different ways throughout the year and influence outcomes is really the policy complex, and that is monetary, fiscal, and trade policy. We'll talk about regulations. We think it's time to talk about it because the relative change in regimes is going to create probably a lot of opportunity for many areas of the capital markets.
Mhm.
Employment. So you don't see inflation on here, right? So again, we're going with the other mandate of the Fed, which we
Correct.
think will be a big driver this year, more so than the other inflation, because I think inflation is under control. Um, and even if you have a worst case scenario for the rest of the world and the best case scenario for us when it comes to trade, it probably won't be nearly as inflationary as you think when you get granular into the numbers. So we are laser focused on employment, and we think that employment level is going to decline or unemployment is going to rise. And we think that is what's going to move the Fed or force the Fed to actually move. And then, shockingly, the one item that is directly in the stock market, earnings and buybacks, barely made the list, right? But we do think when we talk about stocks, earnings and buybacks will be a very important feature this year.
Yeah.
Actual earnings, not forecasted next year earnings. These are the drivers for this year, and I think you're going to see it play out. You're already starting to see it play out. First week of January, it's going to continue.
Yeah. And I think that this is the first year in several years that inflation was not at the top of the list. So let's kick it off with the boss and talk about the
Here's the
10-year
boss.
treasury yield.
The benchmark interest rate,
Yeah.
the ruler of all markets, the most well-known bond that is out there, and the regulator of the U.S. stock market. And what you see here is just looking back over a short period of time when the 10-year Treasury breaks out to a high level or a relative high level, it dampens down the enthusiasm and momentum of the stock market, right? Why is that? Well, ultimately, to get super granular, you should know that quantitatively, lots of money changes hands based on relative moves in the 10-year Treasury. This is all done through high frequency trading,
Mm-hmm.
uh, some hedge funds, a lot of the quant traders, right? And when rates get to a certain level, the trigger says, sell stocks.
Mm-hmm.
Rates come back down, the trigger is buy stocks, right? It
Yeah.
has a lot to do with valuation, primarily, and historical trends, and the creation of various mathematical programs. It is
Mm-hmm.
told to do this. We can't stress to you enough how much money there is in these type of programs that move the market. And then there is the aftershock, the effects of, wow, this happened, right? These computers triggered something, they started moving, and
Yeah.
then people pile on with their emotion. Sometimes you have to see through the short term moves and understand that there is opportunity when you look in, let's call it even 3 month periods instead of daily periods or weekly or monthly periods. This is a chart that shows some of that activity. We kept it short term so you could see the little peaks and valleys. You could see the purple line as it spikes up. There is a perfect negative correlation with the S&P 500 either going down from where it was or staying there, right? Not rising. And currently we have this scenario where even this chart, which is a couple of days old, has the yield off by even 10 or 15 basis points. But the 10-year is about 4.9 right now. And we continue to believe that the boss, the 10-year Treasury yield, when it creeps up or wakes up, it will put a cap on the stock market, and which we think it's actually doing and probably been doing for a couple of weeks now.
Yes,
So
absolutely.
that will play out throughout the year.
And in continuing with the conversation around the boss, there is also a long-term correlation to the PE or the value of the S&P. And I know this is a very loud slide as you look at it, but that long-term trend is that dotted line talking about the fact that the higher the 10-year is, the lower historically the PE is.
Mhm.
One,
Yeah, so a very price-related chart, even though it's not on here, but it controls the valuation of publicly traded companies. It has a very powerful correlation, right? So this chart proves that rarely does the 10-year, when it's at certain levels, allow the stock market to get out of line. When it does, it is because we have well above average economic growth and well above average corporate earnings growth. Well above average. That has been the case for the past few years. The question is, will that be the case for the next couple of years,
fair. Yeah,
right? And occasionally, investors in the 10-year and all these risks, they act up a little bit, and they act as a limiter or a second set of eyes, right? Checks and balances to say, hey, pump the brakes on the stock market. We have some decisions that have to be made. There's a lot of uncertainty. We have to figure it out. So
yeah.
I do end up. I believe the 10-year will be much more lenient on the stock market throughout the year, but right now it is certainly acting as a stop sign,
Okay.
preventing the market from uh, breaking out to another new high. It doesn't mean it won't. It just wants more information first.
And I think also in looking at this year, we need to talk about monetary policy and the Fed's dual mandate that we were discussing about from last year.
Yep. Again, we'll remind you that the Fed has really two main objectives. It's employment and inflation, and sometimes they have to worry about both. Last year, they were really just worried about inflation. The year prior, only inflation. And even the year prior to that, it was only inflation. Now, I believe the weight of their worry is around the employment level, and rightfully so.
Yeah,
And that's a combination of, I don't think they have to worry too much about inflation anymore or for the next 6 to 9 months, but employment, and with some of the incoming policies, thinning out government, the government who has been the biggest hirer, generally speaking, over the past handful of years, may not hire anyone.
mhm,
So what does that do for future employment reports? The data that we're getting, that we got today, the data that we'll get next month is still looking backwards. New regime data probably won't start to roll in until well into the spring.
got it.
So keep that in mind.
Excuse me, sorry, I jumped slides here. Let's talk about the fiscal policy. And what we have here is an update of our current debt level, which is north of 35 trillion.
Why is fiscal policy a big deal? Well, on the top right, we have $35.46 trillion of debt. As of yesterday, it's probably 35.5 trillion as of right now. Um, we have a huge deficit. We can't balance a budget. And we all of a sudden, on the bottom left, have this newfound whopping expense of interest on our debt of over $1 trillion.
Yeah.
And in a higher rate environment with a ton of debt, of course, net interest expense rises. Well, that's not a great thing. You can also see there's a little hint in that other arrow right in the middle, tariffs. We only get about 1% of our income from tariffs. Chances are that will be higher than 1% shortly.
Yeah, and that's probably a good segue into the next slide that addresses tariffs, and this is a hot topic, of course.
Yeah, a 100-year view of the average tariff rate on U.S. goods imports for consumption, so you could see where it was, where it went to, where it is. You know, the full Monty execution and proposal from the Trump administration is on the right in the gray. It goes way up. Chances are that's not going to happen. It might be somewhere around the middle. Let's call it just on average 10% for all. It certainly almost triples the tariff rate, which will have an impact for us from a let's call it a revenue standpoint.
Yeah.
Uh, the question is, what does that mean for various items, so on and so forth, which we'll cover.
Yeah, I think that there's a good slide here, an interesting slide on some of the consequences.
Yeah, this is from JP Morgan. They put this slide together. It is very interesting and seems to be incredibly highly correlated. So, look, there's a lot of talk about tariffs on China, and we America built that machine over there. And well, yeah, of course, we built most of the world actually, at least economically. What you see here is part of the reason why trade is a major topic.
Sure.
When you go back to when China was allowed to enter the World Trade Organization, the WTO, which was, in the early 2000s, very early 2000s, you see that in the US, there was a tremendous amount of manufacturing jobs that were lost. On the right-hand side, you could see labor's share of corporate profits plummeted. And, unfortunately, there were some other bad things. It is very linked to suicide rate starting to increase, and U.S. non-metro poverty rates. So outside of big cities, when you look at like where all the plants used to be, where all the big employers used to be, poverty rates in those cities and towns skyrocketed, right? So when you really want to talk about the great wealth divide, um, when you removed all of these jobs that so many people in this country had, it was more than just a financial hit. It was depression. It was unfortunately things like suicide and just deep dark poverty rates. And look, when you remove someone's career or job, you remove some of their purpose, and it has other effects. So just a very interesting slide that really works its way into why trade both look at the end of the day, both the Biden administration and the Trump administration, who were doing things and now talking about things regarding trade, have sort of woken up to this.
Yeah.
So more to come on this.
Yeah, and I think it's fascinating on the upper right, if you're looking, that the US labor share of corporate profits still has not recovered. It is still almost at an
Of course.
all-time low.
Yeah, we don't make a lot here in this country anymore.
Yeah. Let's talk about regulation. This is certainly another hot one.
Yes. So again, I think this might be one of the stealth big movers in the market for the years to come. So looking at maybe the past handful of years, we have had just an incredible amount of regulation, new regulation, stricter regulation, tons of red tape, which really slows economic activity and forces companies to make alternative plans, at least temporarily. And it is crystal clear here that the cumulative number of economically sensitive rules by the 40th month of each presidency. You can see the Biden administration is like almost off the chart.
Yeah.
On the right-hand side, broken down in a very different way, but in a very eye-popping way. Total cost of final rules in dollars and paperwork hours in dollars. We've reached a level that we've never seen before. And then on the bottom left, the Federal Trade Commission, who really is in charge or oversees mergers and acquisitions, which is, one of the cylinders in the engine that is the United States capital markets and economy. Under the Lina Khan regime, there were very few, if any, completed deals.
Mm.
And the announced deals went away. Pending deals went up, obviously, for the ones that still existed. There wasn't much in terms of completed M&A,
Hmm.
which is very anti-business. And both many Democrats and Republicans agree, not to mention most people, regardless of political affiliation, that are in business. So we think the relative change from these policies to whatever policy we get has to be much more pro-business, and I think that is going to be an enormous tailwind, positive tailwind, for American business. And we're already starting to hear more announcements of deals.
Yeah.
This is what we're going to do. We want to buy this company. We're going to merge. That is going to be a very stealth, very powerful movement for years to come.
Yeah. And that's a trend that's been going on for several years. So that'll be
Yep.
interesting to watch.
Yep.
And I threw myself off in the cadence earlier, jumping into the employment, but as important as it is, we do have a couple of points around this topic again.
Yeah, look, I love the psychology that comes out of the Fed. I love the narrative. I love how they gracefully try to move the needle, try to send a different message. But they release the minutes to their meetings, right? So it's a board and they release the minutes. They
Yeah.
talk about stuff. And those minutes tell the truth, right?
It's all
So
in
you
writing.
still in writing. So this Fed, right? And I love the people who put these charts together because it exposes them. So, the Fed comes out in December and they say, hey, look, we cut 4 times. Even we didn't think we were going to do it, but we did. Don't expect too much more. I'll tell you what, if you want to expect something, we'll give you, I don't know, 2 cuts next year. It's
Mhm.
like, well, in September, that's not what you were saying. So now in December, what happened? Well, look, we're not so worried about employment. We think, inflation could spike up a little bit, but if you ask us by how much, we'll be forced to tell you not a lot, but enough for us to talk about it. Well, what about employment? We'll see. We're not that worried. So then you look at the minutes, and most of the Fed members think there's risk to the upside of unemployment. It's like, oh,
Mhm.
wait a second. Of course you do, because the incoming president is talking about no longer hiring anyone at the government level. Not only that, getting rid of a good chunk of people that work in government. When you factor that into government is really the biggest employer, and if it weren't for government hiring over the past 4 years, we would have had a recession, or we would have had the employment indicator
Mhm.
flash recessionary, which was the only thing missing from calling a recession in 2022. So it was a little bit of gaming the numbers. The Fed's worried about unemployment, as they should be,
Yeah.
which tells me that the Fed is full of it again. They're probably going to cut 4 times. They'll probably do a quarterly cut. They're trying to control the enthusiasm. They're trying to control the expectation of people, the markets, companies to say, look, we gave you some cuts.
Yeah.
Give us a break. We need to regroup and we need to look at data over a longer period of time to more properly measure the trend. And I think that's really what they're trying to do.
Yeah.
Um, there's a chance they don't cut in Q1 because of the recent talking point from December. They don't want to look bad. But I think we'll very likely see quarterly cuts. Let's call it base case for the 4 quarters. If we don't, it'll probably be Q2, Q3, Q4, and beyond. I feel like I have a lot of conviction for this because you also have an incoming administration and a president who is very sensitive to the direction of the capital markets. So,
Yeah.
look, can Trump or the administration control that? No, they don't run monetary policy. That's what the Fed does. But can they control the unemployment level? Well, if the United States government is the biggest employer, you bet they can.
Yeah.
And trust me here, I think they understand that.
Yeah.
Here is some backup. Just looking over the past 2 years, 20% of all job growth came from the government. I don't think we'll be saying that over the next 2 years. So if that's
Okay.
not the case, then one would have to make the assumption that the unemployment level will change. If the unemployment level changes, you can expect the Fed to cut rates because it is part of their dual mandate.
Okay. That's great. And earnings was part of our list this year, maybe not right at the top, but I do love this slide because it looks at historical earnings going back over the last few years, quarter by quarter, but it breaks out the S&P, which is the yellow. It breaks the Magnificent Seven, which is the blue. And you did see this inflection point back in 2023 where the Magnificent Seven, their earnings really did drive the market return through 2023 going into 24. But I think it's interesting to see the six bars to the right are the expectation going forward, which is earnings will not be led just by the Magnificent Seven. The broad S&P 500 is going to contribute as well.
Yeah. If the company's own forecasts of the S&P happen, you will see much more participation from the rest of the S&P 500 because their earnings growth is increasing quite well. And the top seven, who have been growing earnings like we've never seen before, real earnings, still going to be above average, still going to be above the S&P average company's earnings growth, maybe just less extreme than it has been over the past 2 years,
Yeah.
right? Because a lot of that extreme increase came from the extreme decrease in 2022, right? So that was sort of a recovery earnings boost. Now you're going to have, for these big companies, much more normal earnings, which is still incredible and above average growth. But now you're going to have the rest of the market or the rest of the companies in their earnings growth wake up a bit, which certainly creates a lot more opportunity. Now, well, why haven't people just poured money into those stocks? Well, they don't have a lot of slack. They're not as known. They're not as heavily invested in, and they're not as loved. Um, People love the show me stocks, the bedazzled stocks, the ones that are so exciting and in your face and talked about every nanosecond, right? You forget about the rest of the market. You forget who the 335th uh, company is in the S&P 500, right? Not many people care, but we do because there's a lot of opportunity hiding
Mhm.
below some of the bigger companies.
And I think there's a lot of FOMO.
Of course, yeah, it's momentum.
Yeah, absolutely. And as part of this thesis, we need to talk about buybacks, which are at an astronomical record.
And on pace to set another astronomical record.
Yeah.
So buybacks. When you think about investors in the stock market, there are individuals, there are professional investors like us investing money on behalf of our clients. There are institutional traders, right? They play in the same sandbox. There are hedge funds, there are mutual funds, there are indexers, there are pension funds, endowments, so on and so forth. So there are many investors, many different flavors of investors in this market. There's one group that just keeps growing, and it is the companies in the market themselves. They keep buying more and more and more of their own shares,
Hmm.
which removes the share count, therefore boosts the value of shares that are owned by investors. Right? There's a lot of value there. And why are they able to do that? Well, demand for corporate bonds continues to rise. Why? Well, corporate bonds, number one, corporations, when you look at the aggregate balance sheets of the S&P 500 companies, they are in pristine condition relative to any other time in history. And they look like they're getting even better.
Yeah.
So the tolerance for, a little extra risk to get more yield from pensions and endowments who try to, liability match their investments, right? Demand is high and it continues to be high and continues to go higher.
Mm.
So what happens? Well, they buy the bonds of these companies. They even call the company to say, hey, do a bond issue, we'll give you money. The
Yeah.
companies get the money, they pay out dividends, they hire people, they build buildings, and then they have still a whole bunch of cash. What are we going to do with it? Well, we have to do something that is shareholder friendly. We're going to buy back shares of our company's stock, therefore creating more value for you, the current shareholder.
Right.
Wow, amazing.
Right.
So this continues to be and will continue to be one of the key drivers of the United States stock market. And you're even starting to see an increase in foreign markets.
Hmm.
Foreign markets are catching on. Hey, this is what we should do. But they're also starting to get these companies are starting to get a lot of money thrown at them in exchange for their bonds. And what are they going to do with it? Well, they're going to turn it around and buy back their own stock. So the buyback theme is very strong and will continue to be.
Okay, great. I mean, there you have it. There are the five key components for 2025, what we think matters most. Bob, we appreciate the insight.